Good evening, everyone. My name is Ashley Johnson, and I am the Business and Outreach Librarian at the Vernon Area Library. And tonight we're going to visualize retirement with Rich Babchak. And before we get into that, I wanted to mention that this is the last program that I will be hosting for the spring quarter. We are entering into the summer quarter, and we have some great relevant programs that I think you might be interested in hearing about. June 9th, I'm hosting in conjunction with the Glenview Public Library, the Northbrook Public Library, and the Skokie Public Library, a program called The Future of Work is Here, and it's remote. And that will be held on Zoom. So if you're interested in that, go to the library's calendar. We are also hosting a local author on positivity-driven leadership, and that is held June 23rd. And then something that I think after this program, you might be even more interested to learn about. On the 19th of July, we're hosting a speaker on the topic of, he's going to talk about the 10 questions investors should ask their financial planner. So before you start working with a financial planner, what are the things you should ask them? And as far as like an interview or getting to know a financial planner. Okay, and then so I'd also want to run this poll really quick. If you could let me know how many of you are watching the program from your one device. It just gives us a better idea about attendance. If you could quickly fill that out and we'll get started. Okay. Very good. Thank you, everyone. Okay, now with that, I'd like to introduce Rich Babchak. He's a financial planner with decades of experience, and he has an unbiased approach to retirement planning and a focus on helping people sort out the complexities of their financial lives. Rich helps people approaching retirement transition to the distribution phase of life. He's the principal with Midway Wealth Partners and is an adjunct faculty member at College of Lake County. So I welcome you, Rich. I will just kind of go behind the scenes. Let me know if you have any technical issues, and I will be right here to jump back in if you need me.
Okay. All right, so welcome everybody. Thank you, Ashley, for inviting me and having me coming out this evening. Just in my fabulous offices here, as you can see, in Arlington Heights. We're going to talk tonight about visualizing retirement, and then really taking that visualization of what you kind of picture your retirement to be, to hopefully put some foundation under it from a financial aspects of it. So a lot of the things tonight that I'm going to talk about are really non-financial things related to retirement. So I know a lot of people have concerns right now based on how the market is performing, for sure. It's been a challenging year to start. So what I've done tonight is add a lot of material. So hopefully I can explain what's going on, kind of look at where we've been, and really look at some valuations, some charts and so forth, to really help you understand kind of what's taking place right now in the marketplace. So we will kind of conclude with that, but we're going to build up to that with really a lot of non-financial things related to the retirement planning process. So just as my standard disclaimer here, this presentation, it's not an offer to buy or sell any securities. This is meant for informational purposes only. Securities and investment advice is offered through World Equity Group, which is member SEC and FINRA. Midway Wealth Partners is a branch office of World Equity Group located in Arlington Heights, Illinois. We also have an office up in Libertyville, Illinois. And just as full disclosure, I used to be the president of World Equity Group and then owner of World Equity Group. I sold that firm in May of last year, so it's been 1 year now, to another company called Wentworth Management Services. But I am still affiliated with World Equity Group as a financial advisor, as I have been for many, many years. I'm just no longer the president of World Equity Group nor the owner of World Equity Group, but I am the owner of Midway Wealth Partners, and I have a great team that I work with here, and we are still affiliated with World Equity Group. So first of all, I want you to take a couple seconds here, maybe close your eyes for a second. I can't see if you're doing it or not, but really take just a few seconds here to imagine your own retirement. I'm going to be quiet for a second, but just kind of imagine what that would be like. Now that you've got that thought in your head, I'm sure a lot of you thought about travel, maybe doing some travel that you haven't had the time to do, really while you're working and while you're accumulating assets, while you're raising a family, maybe just haven't had the time to do that. A lot of people look for travel at retirement. Maybe sleeping late, you're used to kind of having that grind and that commute of working all the time. And maybe having a little bit more flexibility like that in the morning. My brother-in-law retired. He was a banker a couple of years ago, and he says now what he does in retirement, what he's learned to do is just not set an alarm. He says the body needs what the body needs, and I wake up when I wake up. And he just hasn't got into that regiment of setting an alarm anymore. So just having his body have that freedom and flexibility, to maybe occasionally just sleep in late. Grandkids, the double G's, grandkids and golf. A lot of people want to spend, more time and be around their grandkids, which also impacts maybe where you decide to live and so forth. And golf, I'm a big golfer. I wish I was better, but I enjoy playing golf, and a lot of people want to spend maybe some more time on the golf course. Volunteering, kind of getting involved with charities. I'm sure a few people have thought about that, or maybe expanding roles to charities that they're already involved with, or really making some people taking a more active role in a bigger role in some of the organizations that are meaningful to them. Maybe some hobbies. Maybe you've got some that you've already started. Maybe there's some new ones that you want to do, but a lot of people look to that, towards retirement and being able to do that. Did anybody say Social Security rules as their vision for retirement? No, probably not, right? I don't think I've ever had anybody think of Social Security rules. Well, yeah, they're important. We need to know, when we're going to take our benefit, what age we're going to take our benefit. If we continue to work, does it impact our benefit? Do we take our benefit? Do we take our spouse's benefit? What age would we want to do that? Well, there's a lot of financial stuff, just right there, and just thinking about that. But that's not really what, floats people's retirement boats, so to speak. It's really the other things that you envision your retirement. We need money, and we need those things to make it happen. But the other things are what you really focus on, kind of looking for retirement. So we're going to talk today about why to include these non-financial things, because they're really more important to your happiness in retirement than really anything else. What are these non-financials? So we're going to look at them. I'm going to help you rank them, think about them, rate them, and then really look at how to incorporate those, because some of those, the way you view those non-financial things, the way you view those also determines, sometimes the risk that we need to take in our investments, the positioning of those, the type of income plan that we need, to make those things happen. So we're going to talk about these non-financial things. And then, like I said at the end, just because there's so much going on in the market these days, there's so much volatility, I'm going to talk about that in a little bit more detail. And I'm sure people will have a lot of questions there that I'd be glad to work through. So why include these non-financial things? And said, again, a lot of these things, when we look at retirement, many people have, concerns. I think, I saw a study that said that 90% of people are really looking forward to retirement, but about 2/3 of people are really anxious about retirement. And that's really not unusual. If you think about some of the major events in your life, if that's starting a new job, getting married, having kids, relocating, all the types of things that are major things in your life, usually you are looking forward to those, but oftentimes you're very anxious about some of that change. And retirement is really no different. But there's a lot of emotions that are around retirement. So a study by Greenwald and Associates, I'm going to refer to the study a few times as we go through this, but 74% of people have made a serious effort to plan financially for retirement. That's pretty good. Now, when you look at other studies, the amount of hours that people have put in isn't very good. And when you look at people age 65 and over in this country, and you look at their actual tax returns, and you see where their income is coming from, it really shows that people are not doing a great job of retirement planning. Because when you look at people's incomes, the two biggest sources of income for people currently age 65 or over are working, so continuing to work, and Social Security. And that makes up the majority of people's income. So that's not great. We want to really hopefully have our investments and other aspects, take a much bigger role than what we're seeing. 35% have made a serious effort to plan emotionally for retirement. So emotionally is totally different, and it's definitely impacts things. So I'm going to give you a little example. One of my clients was very set financially, was planning to retire in 2 years. And financially, he had no issue to retire at really any point. I mean, he was sound financially. We'd worked with him for a number of years. He was in a great position. But he got this offer. He got this offer as a buyout. And he asked me to take a look at this early retirement buyout that he was given. And it frequently happens, companies looking to, sometimes move some of the older people out because they're the highest compensated people. But when you look at that, I analyzed it and it said, well, this is a great offer, and you're basically working for free for the next 2 years if you, don't take this offer. So he decided to kind of take the offer. So then we had a lot of things to do to kind of position him, 401k rollover, starting income plans, kind of discussing that, reviewing final numbers, setting up, really the distribution phase of his plan at that point. And so we had another follow-up meeting, shortly after all that was established. And he just looked different. He looked kind of shell-shocked. And I asked him about it. Now, we've certainly talked about some of the emotional things and all that centered around retirement. He had attended one of my other longer classes at the College of Lake County, where we incorporate those things as well. But he really just wasn't ready. He was kind of planning in 2 years. And he just wasn't ready to make that cut from, kind of the grind of working every day into what he was going to do with all of his time. And, about a year later, when I met him for one of his reviews, he just looked totally different. He had adjusted, but it took him a while, it took him a change. So a lot of people just don't, even if they're prepared financially, haven't really prepared emotionally, for the change in retirement. So these are some of the non-financials, the same study, that Greenwald and Associates study, but of the 9 financial considerations that influence retirement. So kind of reaching a certain age was number 1, wanting to stop working, feeling personally ready, wanting to do other things, and finally, kind of tied for 4th, was getting to a certain asset level. So when you look at that, money didn't really enter the equation really until down here. And if you look at some of these words, it's like age, wanting, feeling, wanting. Those are all emotional words. And pre-retirees, this is the study that was based on. When we say pre-retiree, we're really looking at people in the age group, from 50 to 59, kind of as that age group. But these are all emotional attachments before somebody really got down, to that area where, a certain asset level or income level, was really important. Obviously, that makes and funnels everything, but it's not that emotional part, which all of these things kind of dealt with more of the emotional aspects. So, there's benefits for pre-retirees, kind of looking at that holistic view, really the connection between the goal and the solution. And really, I think this helps people through the planning process. As a planner, I am, but really helps people take action. Now, I can say as a financial person that, well, you need to save X number of % of your income for X number of years, get X number of return, and we can provide this much income at retirement. Great, right? But if I said in a different way, well, in order to fund your plans for travel, in order to be able to join that country club for the extra golf that you want to do, in order to spend more time with your grandkids, we need to save X dollars to get to that goal. So it's a little different taking a look at those things, but those are the things that are really important to you, even though the numbers are definitely important, but there's those non-financial things that make things work. And selfishly, there's benefits for us as financial professionals because we really, taking into consideration and understanding all of those emotional things for our clients really helps us really build, long relationships with people. But I'm going to give you an example of just kind of that emotional question as it relates to financial things. So a lot of times, especially when it's closer to retirement and people are looking at cash flow, I'm often given the question of, should I pay off my mortgage? Well, let's take a look at that. There's really two ways for me to answer that question. So most people, at least hopefully you should be, tied into a very low rate. We had the lowest rates in history. We got into the twos and low threes, with mortgage rates. Now, as interest rates are going up and the environment is changing, rates are definitely going up over 5%. But let's say you were locked in as you should be if you still have a mortgage to that 2 and 3% rate. So do you pay it off? Well, there's two ways, like I said, to answer that question. So the first is financially. So financially, to me, doesn't make a lot of sense to pay that off. Why? Because hopefully, and I know it doesn't feel like it this year with the way the market's performing, but generally, getting an outperforming 2 and 3% over a length of a mortgage isn't very challenging. So if we get 4, 5, 6, 7, 8% over that period of time, we're substantially ahead of the game versus on our money versus taking that money out to pay off a mortgage at 2 and 3%. But the other part of that is really the emotional part. Really, some people feel more comfortable not having debt. Some people really are uneasy about having debt. So it's also the sleep at night test. So for some people, the pure financial answer, if you're locked in at a 2 and 3% rate, is no. But sometimes the emotional part of that is, for you, it does make sense because you have a better comfort zone and more of a sleep at night test with that. So those are the kind of the aspects from the planning process that go into that. So hopefully, a financial can help you with that guidance, services, solution, and really address, what's important, to you, which is the non-financial things, the lifestyle, the healthcare, and what that meaning is, long term. But you're seeing now that plan sponsors even agree with this, and companies agree with this as well. But 86% of plan sponsors strongly agree that the retirement journey should be more than just these are the options in your 401k plan. That should be more about wealth and health planning and the different aspects of that over a period of time. So employers also agree as well because a lot of the older employees earn more, have higher healthcare costs, have higher workers' compensation. And they can mitigate those costs, the employer can selfishly as well, by helping people be more fully ready to retire. So this is much more recognized in the industry now. So the next question is really, well, what are those non-financial things that we need to be looking at, and how do they incorporate into the planning process? So what we're going to look at is really what that retirement vision is for you, and everyone's is a little bit different here. And then really look at the non-financial things and creating that personalized action plan for those items, but also then how that retirement vision kind of goes into how your savings and spending plan will be. So we're going to look at kind of some standard rules of thumb, personalized rules of thumb, but really what most of you should be doing and should have is a detailed financial plan, which I'll talk about in a little bit more detail. Retirement income preferences. So there's some trade-offs here. There's trade-offs with, things that are guaranteed, things that are fixed, and things that are fluctuate, and how we need to have those grow over a period of time. So that goes into what our spending plan is. And then our planning preferences, as we'll talk about also as well. So retirement vision. So we're going to look at some of those non-financial aspects. So we're really going to look at what we'll call the 5 W's here. The who, the what, the where, the when, and the why. So the who is gets pre-retirees thinking about the people that they're going to be with in retirement. So that may be different than while you're working. What is refers to some of the activities you want to do and engage in retirement. Where you want to live. When, what that time frame is for when you're going to do that. Is at a certain age, a certain asset level, or when you can provide a certain amount of income. and really why, because that really puts meaning to everything, and meaning is different, as we'll talk about, for different people, but it's also different in retirement versus when you're working. So let's look at the who first. So these are things that Ashley is going to forward to you. So this whole presentation that I'm going over here is going to be forwarded to you. And there's some pages in here like this one where you can help kind of rate and rank yourself and rate these different things that we're going to talk about. So these pages that I'm going to go over, which will really help you think about these non-financial things and looking at yourself today, and then looking at yourself in retirement, will help kind of really put some focus around that. And that will then lead to, from how you're going to, put that foundation, that financial foundation and income plan really in place underneath that. So let's look at your social network. Think about the people you spend the most time with today, and that may change when you retire. So if you do a lot of things that are around work and work related, that might be, you spend 5 days a week at work, at least, maybe, maybe 8 hours a day. That's going to be the most time that you probably spend anywhere, right, while you're working. So, today that could be a 1, but in retirement, that could be, a 6 because you're not going to be working anymore. I'll tell you an example, that's really an acquaintance of mine. He's kind of a friend of a friend, but he plays golf with with a group that I play with, and he recently sold his business. He sold it for a lot. Okay, he has no issues financially with money. It's a long-term financial business. He has significant assets. He just bought a big house in Florida, right on the water, and he still has his house up here. And he decided, he's fully retired at this point. And every time I've seen, he's kind of been alone a lot. So he's not married. He has a significant other, but she has kids that are, more in this area. So she doesn't want to go and spend as much time in Florida as he would like to. But all of his social life really centered around work. He was always going to things. He had with his company, Bears season tickets, Cubs season tickets, would entertain at golf outings and all kinds of things like that. And then all of a sudden, when he was no longer the president, no longer in charge of the company, no longer affiliated with the company, like his social life went away. So sometimes it's a big change, with that who from while you're working into retirement as it was for him. So let's look at your, also as the who, look at your caregiving or your support network. Think about whose health and wellness, that support team is going to be, and whose team you're a part of as well. If you have older parents and so forth, you kind of look at that today, and then you would look at that, really in retirement as well. So the who is our first aspect of really looking at that and how that will change during retirement. So next we'll look at kind of the what, thinking about how you spend your time today and really how that's going to change when you retire. Well, working today might be a 1 for you just because that's the majority of the week. And hopefully in retirement, that activity is going to be last, hopefully, right? So we'll look at some of those other things that you want to do and really kind of rank them, looking at today and then looking at retirement and really looking at how that's going to change for you, really going forward, and then developing some plans around that. So what are the primary things you plan to do to help you live a healthy and vibrant retirement? You can select up to 5. So exercise, eating well, so forth. And we kind of joke about that in my office. I have, I've been doing retirement planning for a long time. I have a lot of clients in their 80s. I would say half of my clients are retired and half, hope to be retired generally in 5 to 10 years. Most of my clients are all over 50, the majority, unless they're kids of clients. But we kind of joke in here and say, I don't have a lot of fat 80-year-old clients. Why? They didn't make it to 80, So eating well, managing your weight, it all is real important. And when you have a large client base like I do of primarily pre-retirees and retirees, boy, you see it live out for sure. Mental exercise is really important, keeping your mind sharp in retirement. I see people that don't do that, and what happens? and I see people that do. My father-in-law is 96. He'll be 97 in January. Lives in upstate New York. He's not in a nursing home. He's not in assisted living. He actually still drives, which is a little bit scary. I'm not sure he did. We actually, last time we were there, did a little check to make sure his driver's license was still valid, but it was. So he's still driving. I don't think that's going to last much longer. But he's mentally, I don't see much difference in him from when he retired at 65. His hearing's not great. His body's, certainly failing, but his mind, he reads online, he reads the New York Times and the Wall Street Journal, most of those, pretty much every day. So he's got a real good handle on what's happening and as things, kind of going forward. So that mental, preparation and keeping that sharp, also very important in retirement. So the where as well. So the where is, where you plan on living in retirement. And there's a lot of factors that go into that as well. And, a lot of people, leave Illinois, unfortunately. Illinois is fairly friendly actually for retirees, depending on what type of income you have. For instance, like pension income is not taxed by the state in Illinois, but if you cross the border to Wisconsin, it is taxed at a higher rate than what Illinois state tax is in most cases. So other states have different tax rules like that, and some states, have no tax, like Florida, Texas, and there's 7 in total that have no state tax. But I see a lot of my clients relocating to Florida, Texas, Tennessee, North Carolina, South Carolina. But there's a lot of things that kind of go into that. A lot of times it's, if your family is here, your grandkids are here, that's the biggest reason I see people that stay in this area in retirement, even though maybe they'd like to be, in a warmer climate. But all those factors kind of go into that. So you want to kind of look at those things today and really look at those things in retirement as to, how you would think they would change, and what's important to you going forward. And then the when. So the when could be answered by a lot of different things. So the when could be just a financial readiness. And that's where having a good, sound, a detailed financial plan is really important to have. Some people, it's just a personal or emotional thing. Some people kind of look at it in timing wise and say, well, as soon as I'm eligible for Medicare, because it's 65, because I don't want to fill in that gap, with the cost of insurance up until that point. Sometimes it could be your spouse and how long they want to work, if they're still working, or what their plan is. So all those different factors kind of go into it. But from the financial side of things, one of the things that you should have answered is definitely where you're at financially. And that's where that detailed financial plan is really important. So you should know what kind of after-tax income with some reasonable assumptions you should be able to do at retirement. And you should know that. So if you're working with a financial advisor, or if you have, financial planning software yourself, it's important to have, those type of answers. And then the why, the why just really puts, purpose around things, overall. And, when you look at that, some people maybe are having a lot of success in their job. You get a lot of recognition in your job. And, when that's gone, that might be different, for you in retirement. But that, sometimes keeps people working a long time as well. But traveling to new locations, not working. So again, what I'd like you to do, like with all of these sheets, is when you receive those, is to put that number, kind of rank those today, from a 1 to 9 in this case, and then rank them in retirement. And then when you look at all these things together, it's really good to compare those with your spouse or your significant other or whoever you're going to spend retirement with, and see if they're kind of on the same page as you. And oftentimes I'll see where spouses or those that you're going to, significant others, haven't really spent time really looking at these emotional things together, and their view is totally different, as to even where they want to be and where they want to be located. But when you look at this, the whys, can be important. And some people, continue to work, let's say, for that recognition, for that success, even though, they can easily retire financially. So it's not that issue with them. So the why. So the 5 W's, are those. And that really should help you formulate those emotional things that would go into and the retirement process, and then really have to put that vision together as to what that is going to be. And then we have to put some financial things, under that. So retirement income and preferences for income. And this is where there's some trade-offs. So what you should know, by having really a detailed financial plan is basically the amount of income that you need. So one of the handouts we're gonna pass on from Ashley is something called I Have a Financial Planner. So it really helps you, the first part of that, organize all of your financial assets, really together. If you have a pension here, a 401k there, just the different aspects that you have. There's a risk profile in there too that will help you analyze kind of how much risk you should really look to take and what type of investor are you. And that should help you really allocate and create the financial plan for what your investments. And then the last page of that is really a cash flow analysis. It really looks at where you spend your money. So how much income do you need at retirement? Well, that really depends, right? So most people, as you'll see from my standard kind of rule of thumb, need about 75% of their pre-retirement income to maintain their standard of living at retirement. But like you'll see, that's just a rule of thumb. So you should really know kind of what that income is and what's your income by really doing a cash flow analysis. If you have software like a Quicken, you can really look back and kind of create that fairly easily. If you're not doing that, you can kind of walk back through checking statements and things like that to look at, or really by just looking at bills and putting together in that cash flow analysis. Then how long do you need those? Well, we typically run retirement numbers, up, to at least age 90, and we would impact that with inflation, taxes, and so forth, kind of going forward. But we certainly don't want to spend our last dollar at age 90. We need a cushion because that's one of the variables, right? We don't know how long that income is going to be needed. And that's where we have to use some conservative estimates that I can talk about when we talk about the financial plan. Variability of income, can your income vary month to month? What I found from doing this for a long period of time is most people want and benefit from level monthly income. So at retirement, maybe they'll have their Social Security. They'll have an investment account. Maybe we'll have the same amount coming out of that. Maybe they have a pension if they're lucky enough to still have one of those. Those are going away though, more than they're coming on. But that would create kind of a monthly income, and it's the same every month. So people can budget a lot easier that way. And a lot of people tend to do better, I think, from a budgeting and planning by having it kind of be level like that. Access to money. You should have most of your investments very liquid. You can have a little bit of asset to take advantage of things that are more non-liquid, but you really have to limit that, in retirement. You should have most of your things and have a lot of liquidity to it. And then, some people have the goal of, leaving money behind. So maybe that's, part of the planning process, from what your income is going to be. Some people want to, bequest money to a charity. Some people want to have, money for children and so forth. Some people tell me that they want to spend their last dollar, or bounce their last check and not worried about leaving anything. So that could be you too. But that's but knowing those things, understanding those preferences, go into how you would recreate your income plan in retirement as well. So one of my clients said he'd like to be buried with all of his money, and so his wife just wrote a check and put it in the casket, right? So you can use that one. But anyway, so we want to look at different types of income so we can have fixed and stable income. Well, lately that's been tough to find, hasn't it? Yields have been extremely low. We've been in a very, very low interest rate environment. That's starting to change, and it's going to change quite a bit more going forward. But most people need to have growth to keep pace with inflation, with their investments and their income. So they need their retirement income to grow. Now we're seeing exceptional inflation right now. And that probably won't continue. It's going to continue for a while, but it's not going to continue, most likely for an extended period of time. So when we look at the last 20 years, inflation's not even 2.5% on average. And we're looking at, having the highest inflation currently over the last 12 months in 40 years. So we're, at 8.5%. And then last month, we had shrunk a little bit to 8.3%, but significant inflation. So we need some growth over time to really keep pace with that. But some people just aren't comfortable with that flexibility. But, you can have, and this is where, again, those income preferences as an advisor are important to understand, because there are ways you can guarantee income. There's ways you can guarantee principal. But that does limit, in a lot of cases, the growth that you can have, with those type of investments. But there are definitely options out there, to create that type of strategy, but understanding that's important. So looking at those retirement income preferences. So now the planning preferences are the next kind of aspect of the process, right? So some people enjoy planning, they enjoy putting the numbers together, they enjoy looking at that, kind of seeing where they're at. About 36%, according to a study by T. Rowe Price, looked at kind of enjoying it. Now, about 52% of people kind of valued that planning process. And then, really about 12% just kind of avoided it altogether. So I had no real interest in doing that. Now, if you're in here, that really should change, because you really need to see, where you're at. And that's where that process of really looking at a detailed financial plan, understanding where you're at, can help you achieve all those emotional goals that you have and getting to those W's. But you really have to have an understanding of it overall. And if you don't want to do that yourself, then I'd strongly look to somebody, that can help you put that together. So then next, we kind of look at those planning preferences, like I said, but then how do we incorporate them? So from the retirement vision, we really need to create that personalized action plan. So we're going to talk about this. So how do we achieve those non-financial things? We may need to learn some things, communicate some things, but we'll want to put really an action plan together for this retirement vision. And then we'll look at, this savings plan and spending plan and how to do that. So this is not on the slides, but there's really 3 components, when I do my classes at College of Lake County that I talk about. And really the 3 components that everyone should have. You should have really this detailed financial plan. And when I talk about financial plan, that's going to include an estate plan. It's going to include education planning if you have kids and are still trying to get them through school and so forth. All those aspects of the financial plan, tax planning, that would be important. Then secondly, you really need a risk management strategy. And I'll talk about that a little bit. But the closer you are to retirement, the bigger impact markets like today will have on you. It's harder to recoup the older you're at. So if you're 30 years old and your account has dropped, 15%, like the S&P has dropped, it's dropped a little more than that right now. But if we're there and you've dropped that much, it's not a big deal when you have 35 years to retire. If you're retiring next year, it's a change, right? So we have to look at having some strategies in place. The older you are, and the more that you look to draw income to effectively manage risk in a portfolio. And then lastly, you should really have what we'll call an income plan at retirement. You've spent all this time kind of accumulating money, right? Growing the money, putting the money away, disciplined about putting the money into the 401k, other savings accounts. But then how do you take the money out and where do you take that money from? So really having an income plan, to maximize that over time is important. So those components all kind of go into what we'll talk about from that detailed financial plan. But first, we'll take that retirement vision, right? And we want to have those non-financial things, but we can create a plan for that as well. So we can have a personalized kind of action plan for those things as well. So maybe there's some things that we need to learn to create that. Maybe we want to do some travel. Maybe we want to learn a different language if we're going to spend maybe some significant time somewhere else outside of the US. Maybe that's one of our goals to do. So learning something for that part of, to make that action plan kind of happen for your personal vision of retirement. Maybe there's some things you need to practice in order to do that. Maybe you say you want to work for charities, but you're not sure which one. Maybe you need to take a look at a couple different ones, get involved a little bit, kind of dip your toe into some things before you commit to something. Well, I'm a golfer. I know I need to practice a lot, but it doesn't seem to get me anywhere and don't have the time. Hopefully I can practice more down the road too. Then communicate. Then unfortunately, you need to communicate those things to your spouse as well. And that's really important, again, to be on that same page. So with all of this, you can kind of create that retirement vision, but break it down into a process where maybe I need to learn something, maybe I need to practice something, and then maybe I need to communicate and share that with my spouse or significant other so everybody's on the same page, with that. So then our savings plan and our spending plan, and so kind of what it leads to next. So I'm going to give you, the standard rules of thumb, which I've already mentioned, but the standard rules of thumb, it's really not personalized. It's really not very detailed. But some people, again, so dread the planning process so much that they just need something that they can look at. So standard rules of thumb are, if you want to retire at 65, you should be saving or have saved about 15% of your income. And you'll need that to replace about 75% of your income. And nationally average like that, about 75% of your income in retirement will generally replace your standard of living or maintain your standard of living that you had before retirement. Well, you're not, why is it 75% versus 100%? Well, a lot of cases, you were putting into 401ks, other savings plans like that, and now you're not doing that anymore. So maybe there's some dollars there. Maybe there's a lot of work-related expenses, things like that you wouldn't have anymore. But on the other hand, like I said, this is just a rule of thumb. It's not very customized. It's not very detailed. And in my opinion, you should have more of a detailed plan. What if you haven't been doing much traveling and you want to travel, in retirement a lot? Maybe you need more than 100% of your income. So maybe you need to save more than 15% to get to that goal. Travel's expensive, or maybe you have some other things that you're looking to do that equally are as expensive. So those things will change, and that's where I think having a more detailed plan and really putting some financial numbers behind that with the impact of taxes and inflation and so forth are important. So standard rules of thumb are kind of something like that. So we can take that vision that you have, those planning preferences, and then have some standard rules of thumb. And then some of these income preferences, again, could even lead to how you should be allocated, the amount of risk that you would be taking in your portfolio, and what types of investments that you have. If you have more things that are guaranteed or more things that are going to fluctuate, with markets as they go up and down. So next would be to, we can personalize that a little bit more. Again, not detailed yet, but personalizing that a little bit more, looking at some of the key categories where people spend their money. So housing, obviously transportation, healthcare, and food. Well, we're seeing a lot of inflation, right? Aren't we, in food right now, transportation with gas costs. If you're locked into a mortgage, well, a lot of the things that you have to buy maybe to support this are going up, but your housing costs are going to be fairly fixed. And we're seeing increases in healthcare always, as we kind of go forward. So when we look at that at a more detailed or a little bit more personalized level, looking at those categories, maybe somebody is good with that. They can, keep that 75% to maintain their standard of living and save that 15 and retire at age 65. Maybe somebody needs to save a lot more than that. Well, currently based on where they're at and what their goal is, maybe they haven't done as good a job saving so far. So they maybe need to save more than that to get to that goal at 65. But some people look at it and say, I can really spend a lot less. I can live, very frugally. I don't need to save as much. Maybe they kind of need to based on, what they've done so far. But, all those, are options that we have kind of putting together the plan. So, but then lastly is really what I think everybody should have is really a more detailed financial plan. So a detailed financial plan should look at, what type of income that you need, first of all. So looking at a cash flow analysis, really to what it's going to take to maintain your standard of living in retirement. Then you should have the impact of some of the key things. So inflation is one of those. So what you start out, if we look at, let's say you need $100,000 in today's dollars to maintain your standard of living, well, $100,000 with even 2.5% inflation is going to change dramatically over your length of your retirement. So you need to build in at least that amount, which is a little bit more than the 20-year average. Difficult to really build a plan around current inflation numbers at 8.5%, but you really should have at least, the 2.5% or so built into that. Other things that you should look at in the retirement plan then would be really need to make some conservative investment assumptions. Now, when I do this for people, what we do is we look at the last 100 years of how the market has performed. We do a target return, typically 5%. Now the market's done better than that over time, has averaged about 7%, but the market doesn't go up every year. So what we do is we look at that over time and how the impact of downturns affect your income over a period of time, taking a random sampling of how the market has performed. Now that can be called different things in the planning world, like a Monte Carlo simulation or something like that. But, assuming that the market is even going to go up every year, and you still need to have assets in the market to keep pace with taxes and inflation and grow your income over time to keep pace with that is still important to have. So those things you would have as part of a detailed financial plan. So conservative assumptions like that. Typically with Social Security, we'll do a break-even analysis on that as to where to take that. But also we tend to leave off in the planning process any inflation adjustments for Social Security. The reason is because what we're seeing is the Medicare premium also goes up over time as you're retired. And a lot of times that eats up that cost. So Medicare premium last year went up 14% from the previous year. Now the Social Security benefit went up the highest that we've seen it last year because of the high inflation environment we're in. It didn't go up as much as the Medicare premium, but the Social Security number is a lot bigger than the Medicare number. So it still was a positive increase in cash flow for people retired. Right now, they're estimating the Social Security increase to be probably the largest we've ever seen if things kind of continue where they're at, or even if they slow down a little bit. Now, that number isn't determined until October. So in the end of October, they'll look at the inflation rate from the previous October, and that will determine how much Social Security will go up into next year. But we generally leave that off. So conservative assumptions are important, conservative investment returns, and taking into consideration that the market doesn't go up every year is important to create the detailed financial plan. So really you want to have a detailed financial plan. Again, a risk management strategy, which I'll talk about a little bit more coming up here, and then really an income plan at retirement, kind of those things. So we can take that vision, create a personalized action plan to help you reach that vision for those non-financial things. You can take that retirement vision, and that helps create what type of income plan that you're going to need and how those assets should be allocated. And then the income preferences can help determine your risk profile and how that income should be structured and what type of investments that you should be in as well. So those things are all important kind of in that non-financial aspects of retirement. So we're going to shift gears a little bit now, and I'm going to look at really what's happening today. So these are some of the major market indexes. I update these numbers kind of as I'm doing reviews for my clients on a weekly basis, based on the previous Friday. So last Friday, the 20th, was the last time I updated them. So the large company stocks, so that would be the S&P 500. So the S&P 500 is really the benchmark or the most common index that's used for comparison for what's happening in the marketplace. So it's 500 stocks, across several different industries. The Dow is also, reported quite a bit, but the Dow, remember, is only 30 stocks. So it's kind of limited in scope as to the number of companies that are in there. But the S&P 500 is down 17.67% as of last Friday for the year. So pretty significant decrease. So when the market goes down 10%, we consider that a correction, and corrections are normal, about every 2 to 5 years. When we get to 20%, which doesn't happen very often, we consider that a bear market. So a market move of over 20% would do that. So in a bear market, in the last 50 years, we've had 6. So we're approaching 7 if this continues, the way it's going. So the mid-sized company stocks, so that would be the S&P 400, not as commonly heard, but that's generally when you look at, if we look at market cap, so cap is capitalization of the company. So that would be really the share price times the number of shares outstanding would give you the market cap. So large companies, we would consider 10 billion or more. Mid-sized companies, generally 2 to 10 billion, and then small companies, 2 billion or less in market cap. So mid caps are down 15.6. The S&P 600, which would be your small cap stocks, down 15.98. The EFA would be your international stocks. So this is Europe, Australia, Far East, minus 14.11. And then this is probably the biggest difference of what we've seen versus previous years. So the Barclays Aggregate Bond Index. So this used to be the Lehman Bond Index, but then Lehman, went through the biggest bankruptcy in history, and Barclays took over the assets of Lehman, so it was renamed the Barclays Aggregate Bond Index. So that's supposed to indicate what the bond market is doing. And that index right now is down 9.18%. So normally what we see when we see markets like this is we'll see the bond portion of the portfolio, if you have one, and most people should, actually go up a little bit or at least remain stable. So the diversification process of traditional portfolios has always been to kind of split between stocks and bonds and diversifying your stocks accordingly. So that hasn't really helped this year, because the bond portion has gone down significantly, not as much as the stock portion, but it's definitely gone down. Let's put that in perspective with the bond market. If we look at the last 50 years of the bond market has only been negative 4 times. Last year was one of them. So we would be looking at back-to-back negative years in the bond market if this holds up. The worst year for the bond market was 1994, and it was down a little bit over 2%. So seeing a number like 9, and we were actually at 10 at one point, a little bit earlier in the year, pretty unusual, and really hasn't happened on a calendar year basis, anything close to that historically. So the next index is the emerging markets. So that's where your non-developed kind of international countries would be. So that's your Brazils and so forth. China's actually in that as well, but down 15.36%. So the only bright spots this year really would be commodities. So if you have a commodity exposure, so access to, where oil, which has gone up a lot, gold, silver, things like that. That's been a nice hedge to have in a portfolio this year. Certain real estate investments have done well this year, and certain segment of healthcare stocks have still done okay this year and haven't really declined like the market, even some of those positive, this year. But there's been pretty few bright spots overall this year. Now, that does happen though. But why is it happening now? So reasons for kind of some of the market and what's happening this year. Well, inflation. So inflation is the highest that we've seen in 40 years. And it's going to take a while to tame that and to bring that back down to what the Fed target is. The Fed target is 2%. So they want to see virtually full employment for the most part, which we're pretty close to right now from our employment numbers. But they also want to see inflation at 2%, and they're behind. So they're admittedly behind in raising rates. So the other thing that's hurting the market performance right now is the Fed needs to slow the economy down, to slow down inflation. And their primary tool to do that is by raising rates. So they first did a quarter, they say things in basis points. So if 25 basis points would be a 0.25%. So that's how they'll quote that or say that. So they did a 0.25%, then they did 50%, and they've indicated that maybe one or two more 50% increases, which we haven't seen in 20 years, at the next two meetings. So that's kind of what's happening. So far the Fed funds rate has increased by 75 basis points or 0.75%. The other thing is that we have no new government stimulus really coming. We had tons of stimulus, in 2020. So remember the beginning of 2020 through March, the market dropped about 35%. So we were in a bear market, pretty significant decline. But what happened? Well, we had the Fed taking rates down essentially to zero. We had the Fed entering the bond market, and for the first time in history, buying all types of bonds. In the past, they've bought treasuries, but this time they bought municipals, they bought corporate bonds. They hugely inflated their balance sheet, which they're unwinding by the tune of about 90 billion a month right now, meaning they're bond sellers right now, which has also affected the bond market, which is another reason we see that index that we just looked at so low. But then the government threw the kitchen sink at this, right? So they had the PPP program, they had handing out checks, that we had trillion plus dollars of stimulus that flowed in because of the pandemic. So right now we're looking at a situation where we have high inflation, the Fed is raising rates, but there's really no new government stimulus on the horizon, most likely, okay? The fears of recession. Now, right now, economically, I mean, I could show you data, numbers, and so forth like that, but it doesn't look like we are approaching just yet a recession. But we'll see what happens here because that threat is definitely there. But remember, the market tends to move 6 to 8 months ahead of economic data normally. So, the market's tending right now, to almost price a recession in, or the fear of that recession in, to the market. We've got supply chain issues. So we've got China shut down for the most part because of another COVID scare over there with their zero tolerance policy. So a number of things have, which is also attributed to or contributed to a lot of the inflation that we're seeing as well. Valuation issues. So, markets were priced fairly high. I'm going to show you our little journey here in just a second. And obviously, unfortunately, the war in Ukraine. So what do we need to see those indexes kind of turn around and things to get better? Now, it doesn't mean things will get significantly worse. I think barring another big shoe to drop, I think we're relatively close, my opinion, to a bottom. We're probably in the 8th, 9th inning where we could see some more volatility for sure, but we're not that far away, I don't think. But that's, we could have another big shoe drop somewhere down the road that changes, what my opinion is there. But what we need to see things is some resolution. So, and that resolution in any of these areas. So if we saw some changes, which sure doesn't look like it's going to happen just yet, but if we saw some changes with the war in Ukraine, that would be a significant boost to the market. If we saw some signs from some of the economic data that inflation was more significantly slowing, that would be a big boost, to the market. But since we're not going to probably see this government stimulus and spending and injection of capital, that's not going to help things. So we need to see some resolution, in some of these other areas before we'd see things turn around. So here's a little bit of kind of where we've been, and it's important to understand that. Now, when we look at these charts, this is the S&P 500, it goes back to 1996, kind of looks at the trends that we've had, kind of when we're in a bull market like this and a bear market. So a bear market is when stocks are going down, generally over 20%. Like I said, bull market, over here when stocks are going up. I'll give you some useless trivia. Why do they call it a bull and a bear? So bull, it's really because how the animals attack. So you can use this at cocktail parties now. But when a bull attacks, he puts his head down and horns kind of come up. So that's where we get a rising market, And a bear tends to stand up and attack on the way down. That's how we get a bear market where things go down. So that's kind of where they came from. But when we look at this, we can look at a couple things. So when I look at this, we'll look at PE ratio. So that's the price of stocks relative to their earnings, okay? So the higher the PE is, generally speaking, the more expensive it is, meaning if the price of a stock is higher relative to its earnings. Now, some stocks just sell at a higher multiple than others. It depends on their growth and other factors that go into this. But in this case, when we're looking at a PE ratio, we're looking at the S&P 500 or the market in general, right? So when we look at this in 2000, so this was our peak here. So remember, right before the dot-com era and what was happening before we had a crash there. So we reached about 25 times earnings. So when we look at that, we say, geez, the market was really expensive. We had a lot of companies that really weren't making money selling at very high multiples. So the market in turn was very expensive. Then we saw the dot-com bubble burst, right? And we saw a 49% decline in the S&P 500, where we bottomed about here, right? So right at the end of 2001. Now the NASDAQ, if we looked at that, went down more. The S&P recovered much quicker. But remember, from this point here, because a lot of those tech companies that were those dot-com era stocks were sold on the NASDAQ actually took 15 years to get back to where it was in 2000. A lot of people forget that. But then we went from here. We had a nice run. So we had about 100% increase up until 2007. So in 2007, though, the market didn't look radically overvalued. We were selling about 15 times earnings here versus 25 back here. But we had a lot of systemic risk because of the financial crisis, the mortgage crisis, and really a lot of our bigger financial institutions, because of the mortgage scenario that was happening at the time, had a significant risk, which caused a significant decline in the market as that collapsed. So we saw a 57% decline. So again, if we had all your assets in the S&P 500, and this is why diversification and risk management is so important, and you were drawing income at that time off this portfolio, it's a lot worse than 57, right? Because if you're drawing income, you're selling on the way down as well. But we hit our bottom here. And then in March of 2009, from there, we were about 10 times earnings. So pretty inexpensive relative to historical standards with the S&P. But then we went on this nice big run, about 400% over that, up until February of 2020. Then we had the pandemic hit, right? So then we had the government shutdown of the majority of the economy. We dropped 34% because of that by March of 2020. So real steep drop very fast. But then, like I said, the government kind of threw the kitchen sink at this as far as stimulus go. The Fed did as well. And we had about a 70, or we had more than that, increase all the way up till here, up until really January of 2022. And now this year we've had this decline, but we're still selling about, as of May 20th, last Friday, about 16.5 times earnings. So getting this down, if you kind of look at this chart, to around 14 times earnings. If you put aside everything that's happening now and all of the reasons why this is happening, would be kind of normal in the market. Normally we go through these expansions and normally we go through these corrections. Now, each time the reasoning is different. So here it was a pandemic, right? Here it was the financial crisis. Here it was the dot-com and the overvaluation. Here it's the high inflation, Ukraine war, things that are happening there. But remember, from the bottom here in March 23rd of 2020 to where we're at now, even after this decline, we're still up 74% from where we were here. So that's still a significant gain. So these pullbacks don't happen that often. But what I'm saying is the reason's always different, but they're normal. But this could still continue for a little bit, just to get down to kind of historical standards, not looking at any of the other reasons and things that are happening now. So this is a little indicator. I like to kind of look at it, but this is one that it's called the Buffett Indicator just because Warren Buffett uses it and has talked about it. But it really looks at the valuation, try to assess the value of the market. And it looks at gross domestic product, and then it looks at the ratio of the value of the market to GDP. So historically, the market is kind of considered fairly valued at 120% of GDP, right? So this is where we were in October 7th of 2021. And when I showed this is, I just had this date kind of pictured because one of the seminars, the last ones I did for the College of Lake County, was right around this time period. So I kind of used this in my class there. I said that, well, you know, really Warren has been selling. And during the year, during this period in here, he had been taking some kind of chips off the table, you know, looking at these valuations of where the market is. Now, when you look at things now, whoops, wrong way, sorry. This has come down a lot, but we're still considerably ahead of where the trend line is. But where Warren up through here was selling, in here now he has started to buy. So he's put Berkshire Hathaway just came out with their, you know, last report, and they've worked about $60 billion, you know, into the market. So they're starting to move, you know, some money in as these valuations start to get a little bit better. But if the trend line here is about 125, we're still above that. We're 169%, but we're not 211% like we were back in October. So you're starting to see those valuations kind of come down to more reasonable numbers. And again, when we look at this chart, that's a normal process. Even though it doesn't seem normal, that's a kind of a normal process, and why it's so important to have, you know, some risk management in your portfolio, but also to have, you know, that longer term perspective. But your risk has to be appropriate with how you view yourself as an investor, as well as where you're at in your time horizon, closer you are to retirement or drawing income off your portfolio. So this is kind of the strategy that we use over time. And again, I can't make you an expert in any of this stuff in this short period of time. But what we like to do normally is combine strategies together. So most people just have a passive strategy. And that's kind of what most financial advisors will use. You know, they'll say, oh, the traditional 60-40 model, right? 60% stocks, 40% bonds. We're going to diversify your stocks by large companies, mid-sized companies, small companies, international, emerging market, diversify your bonds and so forth. And that's fine. You know, you can ride through those ups and downs with the marketplace, but that doesn't really make any adjustments to what's happening in the market. So we really like to combine some different strategies together. So a strategic management strategy or strategic strategy, we kind of use technical indicators of the market to really reduce risk. So, you know, some of the strategies there that we have only had like maybe one down year. Some have had no down years. Now they'll definitely miss some upside, you know, because they're more risk adverse, but they really look to protect the downside and change things, you know, when things aren't working out as well. Tactical would really use economic indicators, looking at that. So you can combine some different strategies together, but the importance of it is really having something in your mix, especially the older that you get, to really minimize the risk of things going down over a period of time so you don't dip as much. You tend to do much better not worrying about a specific index and keeping up with that index, but not dipping as much when the market goes down. Because if the market goes down 57% like we saw before, well, it takes a lot more than 57% to get back to where you were, because you have 57% less money. So it may take 120% to get back to where you were. And that's where the downturns impact you a lot more than missing some upside. So that's where different strategies and understanding that kind of come into place. Income protection, you can actually guarantee income, So some people that are more risk adverse, there are products and things like that. Like I said, it's not appropriate for everybody, but there's a trade-off. But remember, there's the things that make the most financial sense. And there's the thing like my mortgage example where there's financial sense to things. And there's a comfort zone, a sleep at night test. And that's where you can put some guarantees under that. And some people that have maybe a little bit more asset and things to work at, maybe you can look at some higher risk things over here. But generally speaking, without putting any numbers together, general rule of thumb again, like our 75%, if we take income around 4% from how we have our investment structured, you have a pension that comes in, if you're lucky enough to have that, you have your Social Security, and you keep about 3 to 6 months cash reserves. You still need some cash, even though it doesn't pay anything, but just to have that reserves. That's going to be a pretty good judge of what your income can be in retirement without running any numbers. So about 4% from your investments, pension if you have one, Social Security if you're income. If you add that up, that's going to be a decent look at what your income is. Now, life insurance, as people into retirement, people generally don't have as big a need. So usually, when you get retired, the kids are on their own, hopefully, maybe off the payroll, maybe they're not. But life insurance isn't as big a need, because life insurance is generally used to protect your income while you're accumulating money. But once you've accumulated what you're going to accumulate, maybe that's not as big a need for you. Health insurance, well, generally, if you're 65, Medicare, then you would look at a Medicare supplement, or if you have retiree medical benefits from your company, that generally covers most things here. Disability, you need while you're working, and most people that are corporate have that. If you're self-employed, then you kind of need to look at that yourself. But when you get to retirement, it's not something you need. But this is the one that's the big hole for people, is the long-term care. So that's generally your biggest financial expense at some point during retirement, because it's really not covered. There's about 100 days that are covered by Medicare, but then it's just depleting assets to pay for this if you don't have any other coverage. But there are some other solutions that are out there now that can help you with that outside of traditional insurance, which I tend to like a lot better than traditional insurance. But sometimes you can reposition this asset, the life insurance, on a tax deferred or tax-free basis into something like this that can solve your long-term care. And then ideally you need your estate plan. So you need appropriate will, a trust maybe, powers of attorney, just depends. You definitely need at least the basic would be a will and powers of attorney. Trust, a lot of people, there's certain benefits there, which we won't go into today. But power of attorney, you need really one for property and one for healthcare. And then any of the accounts that you have here, you need to coordinate with what your estate plan is down here. So that means your beneficiary designations, or if you have a trust, your account titling needs to be coordinated with whatever you set up down here for your estate plan. But you definitely need an estate plan, to really protect you and protect your assets over a period of time. So the process generally should be in the planning. So we take all those things that we talked about from all those emotional things. We look at all the risk profile things. We look at all the asset things and all that information, gathering that to really put together a detailed financial plan. But the next thing that you need to do is implement that plan, then really review that plan over time, and then really modify and change that plan as you have different life-changing events. That could be retirement, job change, house downsize, death of a spouse. Could be a lot of things that affect that. But those are all the things that you kind of need and what the process would be. But up front here, understanding all those both financial and non-financial things are all the things that would go into what that planning process would be to make that happen. So creating a plan around your vision. So there's a financial statement. So one of the things that we're going to, if you haven't received yet, Ashley was going to send along, was our financial planner. So what that does, it will help you put together your own financial statement and organize all your things. There's a cash flow. So if you're looking at, well, how much do I really need at retirement? And then how is that going to change based on how we did all these retirement visions and goals? What do I need to do? Do I need to increase my travel category? Do I need to decrease another category? How do I need to do that? But that cash flow will help get to an income number. And then there's a data sheet that puts that all together. There's also a risk profile that's in there as well, which helps you assess yourself as an investor to see if you should be more conservative, more moderate, more aggressive, based on how you answer those questions. Hopefully that helps you. And then, you can use all that to put together a long-term plan. Again, more sophisticated, would be having those different strategies and management, which we can't really go into today, but having some way that you're managing risk of the portfolio. So when we have a 20% drop, hopefully it doesn't turn into a 57% drop like the last one did during the financial crisis. So you can protect and preserve your assets and income long term. But a good financial plan should have retirement planning, insurance planning, education planning, estate planning, risk management, tax planning. So, if you're not comfortable doing that yourself, again, seeking out some financial advisor that you'd feel comfortable with, or making sure your advisor is doing those right things for you, I think is important. So why include those non-financials? So financial, non-financials drive your retirement happiness. So again, all those financial things that I went over won't make you happy in retirement. What's going to make you happy is really achieving all of those non-financial things, really that vision that you have for your retirement. That's really going to determine your financial happiness. The money part of that certainly is important to make those dreams come true, but that's, it's not the thing. Having the neatest financial plan isn't what's going to be important. It's really identifying all those non-financial factors that are going to drive your retirement happiness. So that should have your retirement vision, like we went over, your retirement income and planning preferences. Use that financial data sheet, that real risk profile, that cash flow, help you to create your personal plan, and hopefully put together a retirement savings and spending plan. So that's where I was going to end. So I hope I can answer any questions. I'll get rid of my screen share, hopefully, somewhere here. And I can answer, hopefully, any questions that people have.
That was really great. Thank you for that. I had a question about the, the long-term care insurance.
Yes.
As a person that isn't approaching retirement age, do you think that is something that, is it one of those things where like the sooner you get in the pool with that, the better you are? Or is it like, what is the best time you think to
Yeah,
really
that's a good question. Usually we wouldn't start looking at that to somebody generally around age 58 and above. Once you get north of 65, it tends to get a little bit too pricey. Right. But there's traditional insurance that's available. And just to talk about that a little bit, that's where you kind of pay. It's just kind of like car insurance. So you're paying all the time. You may use it, you may not use it, but you're always going to be paying. And what we've seen with that, since I've been in this business, when I first started, there was at least 25 companies that had that. Now there's a handful of companies. Many companies have exited that business because it's very difficult for insurance companies to assess what their costs are long-term in that area. So people have generally been living longer. We've got this big bubble of baby boomers that are still retiring. So there's a lot more demand for that coverage, and the cost continues to go up. So what we've seen happen is when people have bought traditional insurances, the companies over time raise the prices and increase the prices. So there's another solution that's out there. It's called a hybrid solution. But I like personally the solution a lot better. It's a little bit more capital intensive up front, but over the length of the insurance, it generally is less expensive. but you do have to have some assets to put into it. So basically, it's a stripped down life insurance policy. So it has a very, very minimal death benefit. It has a long-term care benefit. You can get inflation protection on the long-term care benefit, and it has a cash value to it. But what's going to happen? Well, if you need long-term care benefit, generally you're going to have about 4 times what you put into the policy as a benefit. If you pass away and you never get to use that, your heirs will get your money back plus a little bit of gain through the life insurance. If you just say, I want to walk away from this, you can get your money back. No gain or interest on it, but you can get your money back. So sometimes, you have to look at, there are some different solutions out there now that, just depending on the person, would fit better, in my opinion, than traditional insurance. But it just depends what a person's situation is, asset level is, and so forth. But a lot of times you don't have to fund the whole solution, because if you have a pension coming in, if you have certain investment income that you can depend on, if you have Social Security coming in, those things hopefully are still going to come in. So sometimes you're just filling in the gap for what you need.
All right, very good. We had a question come through the Q&A. If you have a question or if you have a comment, please use the chat or the Q&A. Next year, I plan to start a pension from a previous employer, which was a bank. I did not contribute money to the pension. A recent Social Security statement mentioned Social Security might be reduced when started. If there is also a pension the recipient didn't contribute to, does that apply to me? I don't plan to start Social Security until I turn 70.
Right. So Social Security, so the only impact of Social Security that you have is if you retire before your normal retirement age. If you retire before your normal retirement age, let's say it's 62, up until whatever that normal retirement age is, and that depends on when you were born, that could be 67 or 66 in some months and so forth, you have a limit on as to how much income that you can make. Which is 19.5 right now, up until the year that you turn retirement, up until your normal retirement age. The only income that affects that income limit is earned income. So pension income is not considered earned income. So that would be just continuing to work. If you're going to wait till age 70 or even hit your normal retirement age, it doesn't matter what your other income sources are. It won't affect your Social Security benefit.
Okay. There's another question. It says, given the Fed rate of 0.75%, what suggestion do you have for retirees to get some income yield? Is there a fixed income instrument giving 4 to 5% annually?
Not yet, but there will be. So we're starting to see some higher yields. So there are definitely financial instruments to get much higher yields right now based on how the market has declined. So there are closed-end funds that I can find that are 7 and 8% right now, but they have market volatility to them. So you have to look at what type of investment that you're really looking for. If you're looking for something where your principal is guaranteed in some way or protected in some way by either a corporation or things like that, we haven't, without, and it depends on also the risk that you want to take. So I can find 5% in a bond, but it may not fit your risk profile. Meaning there may be too much risk in it. So there's definitely instruments and things that you can find, from closed-end funds to individual securities and individual bonds, where you can get higher yields now. And those yields are going to continue to go up as rates go up. So eventually, before the end of the year, we could find something that's in that range that could be fully guaranteed by somebody if rates continue to increase like we expect them to. So that's going to continue to improve. So the only thing I would suggest there is really having some flexibility, really understanding your risk profile as to something that delivers yield, because there's a wide range of risk out there. But also, I wouldn't be in a hurry to lock into something right now for an extended period of time when we expect rates to go up, quite a bit more, throughout this year.
Very good. I also just, thank you. I think that the strategy and the thought process is refreshing, thinking about what you want as far as living in retirement. Like, I think that's refreshing, and you don't hear about it all the time when you talk about retirement. It's always so much about the money, which, I mean, it is very, very important, obviously, but there are other things besides the money when it comes to retirement. So I appreciate your insight on all of that. And as for your attachments and everything, I'm going to just send them out to everybody after we're done here. I'm going to wait for the Zoom to download, and then I hope to get it out tonight just so I can have it off my mind for tomorrow. But I thank you so much for your time tonight, and very good presentation. I will include your contact information in that email as well. Your email, I'll copy you on it. So if anybody wants to reach out to Rich, you can do so, and go on from there. All right. So thank you, and have a great evening, everyone.
Thank you for having me.
Bye-bye.
Bye now.